Don't worry, I won't sing, but yes, credit unions have their own version called the NCUA, which is the National Credit Union Administration. This is another independent federal agency, but instead of covering commercial banks, they cover credit unions. It was created about the same time as the FDIC, and it bounced around between different agencies before where it is now, and I didn't write that down, but I really should. During the banking crises in 1980s and the 1990s, the boards charged credit unions a premium to kind of make sure that there was a little more cushion for their funds. The premiums either stayed as is or they disappeared. I was a little confused on that. Things started to go well for a while. There weren't very many credit unions closing, but then in 2008, they charged premiums again because of the economy. Along with everything else going on in 2008, there were bank closures because of things like increases in home foreclosures, business failing, and unemployment. They've done a few more things over time, such as adding more safeguards and making sure that there's more security behind the money that you put in credit unions. Much like the FDIC, the funds for the NCUA do not come from the federal government. The National Credit Union Share Insurance Fund provides deposit insurance to protect the accounts of credit union members at federally insured institutions in the United States. Created in 1970, the Share Insurance Fund is administered by the National Credit Union Administration, an independent federal financial regulator. And a positive thing to be aware of, the Share Insurance Fund is funded completely by participating credit unions, and not one penny of insured savings has ever been lost by a member of the federally insured credit union. The Share Insurance Fund is backed by the full faith and credit of the U.S. government. So once again, the president can't come in and just pull funding because they feel like